Picture a private rail car in 1910, shades drawn tight. 6 men use fake names and promise not to write notes. They are not planning a heist. They are redesigning American money. That secret trip rewired your paycheck and your mortgage. Stay with me. America had just survived the panic of 1907. Trust companies failed and depositors ran for the doors. J.P. Morgan locked bankers in his library to stop the spiral. There was no central bank to lend in a crunch. Payments jammed, credit froze, and factories went dark. Leaders agreed on one thing: this could not happen again. Enter Senator Nelson Aldrich, the most powerful finance voice in Congress. He formed a National Monetary Commission to study solutions. Europe had central banks with discount windows and elastic currency. America had a patchwork of banks and seasonal cash shortages. Aldrich wanted a plan built by experts, not headlines. In November 1910, Aldrich invited a tiny team south. They left from Hoboken on a private rail car with shades down. They used first names only to hide identities from porters. The destination was Jekyll Island Club, a secluded Georgia retreat. Its members were America's corporate elite and winter residents. Privacy was guaranteed by marsh, pine, and distance. Who went on that train matters. Aldrich brought his aide A.P. Andrews, a former Treasury official. Henry Davison came from J.P. Morgan's firm. Frank Vanderlip represented National City Bank, a giant of the time. Paul Warburg, German Bank, New 5 Playbook. Benjamin Strong, a Rising Star, with York Fed, different employers, one shared goal. Stop pain n'en be payé. Inside the clubhouse, they drafted the Aldrich Plan. The heart of the plan was a National Reserve Association. It would hold bank reserves and act as lender of last resort. It would issue a flexible currency backed by commercial paper. It would rediscount short-term loans to keep trade moving. It would clear payments so money flowed between regions. In simple words, it was plumbing for confidence. Why the secrecy? Because trust in Wall Street was thin after the panic. Any whisper of a banker made currency could kill the idea. Secrecy let experts hammer, mechanics before politics took over. They worked for days, then quietly went home. Aldrich unveiled the plan in 1912. He had science and Europe on his side. He did not have votes. Progressives saw a cartel in banker clothing. Farmers feared credit would favor big cities. A presidential election loomed with reform in the air. Woodrow Wilson won the White House and altered the design. He kept the plumbing and changed the power. The Federal Reserve Act of 1913 created a compromise. 12 regional reserve banks would share the system. A Federal Reserve Board in Washington would oversee policy. Member banks would hold stock in their regional Fed. The new system balanced local knowledge with national coordination. In 1914, the Federal Reserve opened its doors. War in Europe soon tested the new machine. The Fed helped finance trade and stabilize gold flows. After the 1920s and the Great Depression, lessons deepened. In 1933, deposit insurance calmed retail panics. In 1935, reforms strengthened the board and clarified roles. In 1951, the Fed Treasury Accord cemented policy independence. In 1971, the dollar left gold and policy moved fully to rates. In 1977, Congress gave the Fed a dual mandate. Price stability and maximum employment sit on every FOMC agenda. What did the Jekyll design actually change for you? First, elastic currency replaced cash droughts. When demand for money spikes, reserves can expand. Second, a discount window stands behind solvent banks. Loans against good collateral can bridge panic hours. Third, a national clearing system keeps payments moving. Your paycheck and card swipe ride those rails daily. The system is not flawless, and history shows it. In 2008, mortgage securities cracked and funding vanished. The Fed became lender of last resort in modern form. Term, facilities, and swaps kept credit markets from freezing. In 2020, the pandemic stopped the real economy overnight. The Fed cut rates, bought bonds, and opened emergency windows. In 2023, regional banks faced a confidence shock on screens. A new lending program let banks borrow at bond face value. Again, plumbing aimed to buy time for confidence. Why does a 1910 train ride still matter now? Because design choices outlive designers. Regional banks plus a central board still shape every rate move. Your mortgage, your savings yield, and your job market all respond. When the Fed raises the policy rate, borrowing cools. When it cuts, credit loosens and demand returns. Behind each move sits a blueprint drafted in secret. There are fair critiques, and you should hear them. Secrecy at birth fueled distrust for generations. Bankers had a heavy hand in the first draft. Politics, later, added goals beyond crisis control. Yet, the core plumbing solved a real failure. A system without a backstop kept burning down. Here is the simple model to remember. Elastic money reduces cash droughts. A lender of last resort prevents solvent banks from dying. National clearing lowers the chance of regional choke points. Rules and transparency must keep power from drifting. That balance is the Fed's constant homework. Let us zoom in on one design choice. Rediscounting commercial paper sounds technical and dusty. It meant turning trade IOUs into central bank money quickly. Factories could meet payroll and shippers could pay crews. Today, the instruments differ, but the idea is the same. Turn good collateral into spendable cash when fear is high. Keep commerce from stalling over the weekend. Another choice was decentralization. 12 reserve banks read local credit better than a single tower. Cotton, rail, steel, and ports moved on different cycles. Local data fed national policy with fewer blind spots. The board provided coordination and guardrails from Washington. Compromise turned an elite draft into a democratic system. So what is the real legacy of Jekyll Island? Not a conspiracy tale, a blueprint. A design to trade secrecy at birth for stability in use. A design to turn panic into plumbing and rumor into rules. A design that still sets the price of your money. 3 takeaways for your wallet. Policy is architecture, not magic. Rates, credit, and jobs react to design choices from 1913 when you were the Fed. Think pipes, valves, and pressure. Good plumbing is invisible until it fails. Understanding it helps you time debt, savings, and risk. If you want more hidden money stories that explain today's rules and help you make smarter moves, subscribe now.